Hello there and welcome to the Core Finance London show, where I'm joined by Marc Ostwald, who's a strategist at ADM Investor Services. Happy Bastille Day.
Oh, happy Bastille Day indeed.
Bonjour and everything. That's about as far as I can go. France is on fire at the moment, isn't it? You've got the new handsome young president. It's a bit of a Justin Trudeau effect there going on.
There certainly is, and thus far, and I was quite impressed by the meeting between Macron and Merkel yesterday. He does seem to be starting to deliver, but there are a lot of reforms still to be enacted, and it's on that he's going to be judged, and on whether he can persuade Germany to start giving some ground. Yesterday's offering was good. Mrs. Merkel basically suggested we can talk about this, which is an improvement on what we've had before, because steepening Eurozone ties is clearly a very, very important aspect. The Eurozone won't survive until they actually have areas of common budget. And on that, Germany is going to have to start giving some ground. At least it wasn't the attitude that we used to have from Germany, particularly from Mr. Schäuble, which is like, no, we're just not going to discuss it. That's it, our last word. But it doesn't necessarily mean that they're actually going to come to an agreement on this.
Okay, let's see what we've got as the headlines today. Cautious Fed lifts stocks to record highs in the US anyway. Investors eye earnings boost. I'm not sure where the boost is going to come from, but people are keen.
Yes, I think the market's taken a rather lopsided view of what Mrs. Yellen said, and they didn't even pay any attention yesterday to when she corrected the market reaction on Wednesday, and to make it very clear that she saw the risks to inflation as being two-sided, i.e. up or down. The market's focused on her basically saying it's down. And for the time being, they are hoping that means basically that the Fed's going to be rather more cautious with its tightening than they had previously assumed. I think the truth of the matter is we've had this quite sharp rise in government bond yields. It had no effect on riskier assets, particularly credit. And as long as credit doesn't actually start to crumble, and there's absolutely no sign of that at the moment, then the incentives to carry on buying equities on dips remains very high, given that interest rates remain very low. Though it is worth noting that we have reached a high of 1.3% on 3-month LIBOR, so cash is gradually becoming a more viable option, and that's something which does need to be carefully watched.
Okay, we'll do that. Next, we've got the FTSE company to watch, a recruitment firm. Never needed the services of that. I just get headhunted wherever I go. But the company said that it was profit would be marginally ahead of expectations or consensus expectations of 209.5 million, with international businesses continuing to be the key drivers of growth. Looking on to the AIM stock of the day, another area which is I'm not quite not familiar with either. It's fashion, online fashion, and amazingly, even though you've got people like Amazon dominating the sphere, people still go to these individual online retailers.
Well, it's a classic case of the online retailers continue to benefit from this migration away from bricks and mortar retail. Whether that trend is coming to an end or not is debatable, because it still seems that the competition that they're able to provide is enormous.
Right, and I mean the key driver here, according to ASOS, is that overseas sales. So that's obviously good news for them with the those currency benefits.
Definitely.
Pound just below 1.30, the critical $1.30 level against the dollar, and back down after the blip during the week, courtesy of Ben Broadbent, back towards the 88 pence level. Looks comfortable at both those levels?
I think it looks like it's quite firm, but it's not really a case of the pound being firm. It's more a case of the dollar being weak in reaction to Mrs. Yellen. I think there's going to be a lot more volatility, because clearly at the Bank of England, on the one hand, you've got Ben Broadbent saying he hasn't made his mind up about a rate hike in August. On the other hand, you've got someone like Mr. McCafferty suddenly throwing a complete spanner in the works and talking about maybe the Bank of England needs to start discussing shrinking its balance sheet, which would obviously be sterling supportive.
So it's like mutiny on the bounty, isn't it, really, at the Bank of England at the moment?
Well, I would say in terms of guidance, there isn't any. They're guiding all over the place. And if there's been one message this year from the central banks, and where the Fed has succeeded in tightening policy, even though financial conditions have actually eased, it's you sing from the same hymn sheet. The Bank of England doesn't even seem to, all the members of the MPC don't even seem to have the same hymn book.
Right, that's unfortunate, or that could be unfortunate. On to the broker recommendations, where Barclays, in their infinite wisdom, have noticed that Premier Oil has discovered 2 billion barrels of oil in Mexico and decided to raise its target grudgingly from 57 pence to 72 pence. But it's not amused or impressed by the 2 billion barrels and it keeps the recommendation or the rating of the company equal weight, which is quite an achievement. I'm not sure how much oil they would have wanted.
I suppose there is some consistency because Barclays did one of the biggest downward revisions to their oil price forecasts for this year. So they're basically saying it's all very well finding 2 billion barrels of oil, but what sort of price are they actually going to be extracting it from the ground, and will that actually be profitable? And that is probably a good question.
I would have expected at least a pat on the back, but there we are. Core number, we can guess what that is, a 50% pay rise for you next month?
That would be nice. It's not going to happen.
Right, well, apparently that core number is actually the way that cashless payments have now just overtaken the banknotes.
Yeah. And, this it is an enduring trend. I don't think we're ever probably going to get to a cashless society unless we can actually get to a situation where you can guarantee, in the event of a terminal failure in a shop or a restaurant, or in the event of a power cuts still happen, that you would be able to pay. Because if you haven't got any cash, how are you going to pay?
Or everybody's very keen on paying tax. That's obviously going to happen, isn't it?
Yeah.
Economic calendar, today retail sales in the US and consumer price index as well, so that's pretty important. And industrial production 45 minutes later. Any highlights there for you?
Yeah, I mean, I think these are big numbers. I think what one needs to do on the US retail sales, we're not looking for a big number on the headline, but the core number is expected to pick up and thus underline that, excluding falling gasoline prices and weaker auto sales, which have come off a very overinflated level of sales, underlying spending is good. Consumer prices, and this is really where the big debate in the market, are expected to drift down to 1.7 year on year, unchanged on the core measure. There are a lot of special factors at work here, and that's going to be those elements like mobile charges, pharmaceuticals, which Ms. Yellen went. And the very peculiar one on this one is clothing prices in the US. If you actually look at the 3-month annualized rate of clothing prices in the US, they're down minus 6.2%, which to me seems improbable given that clothing prices have been dampened for a long, long time, and I'm not sure how much further we can cut those.
But how's that affecting the retailers? They must be crying.
Well, certainly, I think a lot of it has to do with competition, going back to ASOS, between bricks and mortar retail, which we know is doing particularly badly in the States, and online sellers.
And so we presume that this has only changed once Amazon have found a point where even they can't stab people in the back.
We will get to some form of asymptotic level where the tide will start to turn, particularly given profitability. We know Amazon's margins are absolutely tiny, but when we start stranding a lot of bricks and mortar retail assets, there's going to be some problems.
Marc Ostwald, strategist at ADM Investor Services, thank you very much indeed. I will. I'll just say goodbye again.
Oh, right.
Marc Ostwald, strategist at ADM Investor Services, thank you very much.